Brad Williams, Frugal Finance. Let's talk about mortgages. Let's talk about balloon payments. What is a balloon payment? When is one allowed? You're going to see what's called a 5-1, 7-1, a 5-1 balloon, a 7-1 balloon. These are the terms used when shopping for a home mortgage. So what are they? A balloon payment on a mortgage is a large one-time payment at the end of the loan term. So after 5 years, guess what? That term is due. In other words, you have 25 remaining years on the loan, but the loan is due. Now, you can roll it over to the remaining 25 years, but the rates generally are not favorable unless interest rates have dropped considerably. And that's the bet some people make. You're going to think, well, I can lower my overall payment. 5-year, 7-year balloons, the interest rate is considerably lower than a 15 or 30-year deal. Or if you think that you plan on moving with about 95% certainty, then a 5 or 7 year may work. Now, I fell into this little bit of a trap some 30 some odd years ago, 40 years ago, or what have you, where I purchased my house or I refinanced or whatever I did, and I put it under a 5-year deal going, there's no way in heck I'm going to stay in the house that I just bought. Well, here I am 35, 40, whatever years later, and I'm still in the same house. So be careful. If you think one thing and you do another, you ultimately either have to pay down the mortgage or you're going to have to refinance. Or you're going to hope that interest rates move lower and it'll be a reset. So then you can reset it and you'll have the term, whatever that rate is, and it's usually an adjustable rate mortgage, which is pathetic. That's the sad thing about these deals. If you end up rolling it over, resetting, it'll be an adjustable rate mortgage. If you have a mortgage with a balloon payment, your payments may be lower in the years before the balloon payment is due, but you could owe a big amount at the end of your loan. Loans with balloon payments generally have shorter terms than traditional mortgages, ranging from 5 and 10 years compared to 15 or 30 years. They are designed to have lower monthly payments that do not fully pay off the loan over the term, and then a large last payment called the balloon. Balloon payment is generally more than 2 times the loan's average monthly payment and can often be a significant portion of your entire loan amount. A mortgage with a balloon payment can be risky because you'll owe a larger payment at the end of the loan. If you're considering a balloon loan, you need to think about whether and how you can make the balloon payment when it comes due. If you're unable to make this payment, you could lose your home. Before the end of your loan term, when the balloon payment is due, you may be able to refinance your loan to avoid the balloon payment. However, if the value of your property falls or if your financial condition declines, you might not be able to do so. You could face foreclosure. Note, balloon payments are not allowed in loans deemed a qualified mortgage with some limited exceptions. If you're confused about how these work, comment and I will take a look at it and I'll address any of your concerns. Brad Williams, Frugal Finance. Hope that helped. Thanks for watching. See you soon.